I'm Valentina Sanchez Cuenca from the Bird Shops Report. I'm here with the LATAM team. Today we have Robin Van Battenborg, CFA, longtime friend, longtime contributor. He works with us in New York. And also we have our CEO, founder, and New York Times bestselling author with an upcoming book that you can find in the description below, by the way. And guys, I've been hearing a lot this week, a little bit last week. We have the chat that you can see behind Larry. We have around 600 institutional investors. And I've heard some people talking about very bullish signs forming for the energy sector for next year. What really is driving this? Is it mergers and acquisitions? What's really going on? What should we expect?
Thanks, Valentina. And I want a special thanks to Robert Van Battenberg, the Dr. Robert Van Battenberg, I would like to say. We did Rob wrote a report in March, April, around potential mergers and acquisitions in the energy space and kind of like an under the surface bid that's potentially there. I mean, think about just ExxonMobil alone. 4 years ago they had, maybe 4 or 5 billion in cash. Now I think it's approaching, 30 to 40 billion in cash. So the energy equities, the larger majors are producing tons and tons of cash, Exxon, Chevron, and there's a lot of candidates out there. There's another merger in the energy space today, Rob, and clients. So, Rob, in your conversations with clients, and Jose, you can bring up the first chart, the bubble chart on the energy patch. But, Rob, in your conversation with institutional investors in the chat this morning, what are people talking about in terms of bullish signs for 2024? Is this an energy bid for equities under the surface that's going to kind of be there next year, and then get into the whole strategic petroleum reserve and all the other factors that could support prices for next year, especially with the Russians and the election?
Yeah, one things that work here. The deal that was announced today was Occidental buying Crown Rock, which is an operator in the Permian, so it's mostly shale oil.
I'm sorry, what was the name of the acquisition target?
Crown Rock.
Crown Rock, okay.
So it's a private company, but they're mostly active in the Permian and in shale oil, so that's Western Texas. And it sort of speaks to some of the concerns that we already addressed as well, that natural resources globally are, companies are getting more concerned about the safety and the continuity of their assets globally in the wake of a number of concerning developments around some of these natural resources. To mind comes, of course, the recent referendum in Venezuela about a region in Guyana that they claim to be theirs, Essequiba.
So in broad terms, Rob, so it's a more multipolar world, more global conflicts, less global cohesion that we might have had in a unipolar world. Is that kind of the concept? And then that has an impact on where companies are going to want to buy assets?
Yes, the companies want to buy assets close to home. Crown Rock is sitting in Texas. It's not going to go abroad. I think Exxon, when they made an investment in Guyana, thought, well, the Caribbean is close enough to home, so maybe it's safe here. But it turns out that's not the case. And we have had other examples as well. We have had a lot of coup d'etats in Western Africa. We've had, of course, contract renegotiations in Chile on lithium. I mean, the list goes on and on and on. So this is an interesting development, which makes domestic independent energy production and exploration companies, so the smaller E&P companies in the United States, very attractive takeover candidates.
Okay. Okay. We'll use the chart to tell that story. So at the bottom part of the chart, you got the enterprise value to reserves. That's really important. So the value of the stock on the enterprise value of the equity versus the oil reserves. And on the left-hand side of the chart, you've got the percentage of total production.
Right.
So can you walk us through the chart itself? Like what's that chart saying in terms of opportunities?
Well, have the enterprise value, which is basically the value of the firm, divided by the reserve they have in the ground. So if the more to the left the company is on the chart, the cheaper it is, right? Less value of the firm relative to the reserves. And on the other chart, going up and down, it's basically a breakdown of how much of the total reserves is natural gas and how much is oil. Right now, oil is more attractive than natural gas simply because oil has a lot better price formation than natural gas. That's this year. Um, Having said that, there is even some M&A taking place in the natural gas space as well. It's just that the natural resources that are available domestically or in jurisdictions that are safe, be it Canada or Western Europe or Australia, are becoming more attractive because these oil companies, they rather buy an asset that is already developed close to home than go out there in the middle of nowhere and try to dig for oil. And who knows who comes around and lays a claim on their assets. What I was going to say, of course, Russia is the biggest example here, right?
Yeah,
So
let's talk about
Russia,
the election. So let's talk about 2024. In the election, we were lectured and lectured and lectured and lectured again in 2016, 17, 18, that the Russians wanted to rig the election. We were lectured, and I mean, literally hundreds of millions of dollars are spent on this investigation, and the time and the overall time and draw from the economy. But it was about election rigging and the Russians and Facebook
right?
ads and the whole thing. So if that was the case, if Putin really wants a Trump win or versus Democrat, why wouldn't he like hold back reserves production in an election year where the U.S. has a very low strategic petroleum reserve? In other words, can't he almost want to couldn't he talk to the Saudis and create a small energy crisis in an election year? Is that possible?
Well, it's there's things that are likely, right? In the market, it's priced in that the Fed is going to cut interest rates next year. That's a likely event. It's not 100%, but it's priced into the market as being very likely. And there are things that are possible. And this is one of those things that is possible. It's
But it
not
makes it
priced into
more
the
likely than possible because we were lectured and lectured and lectured that that's what he wants to do. He wants to rig
well,
and fix U.S.
this is that
elections.
it's a possibility because it's not priced into the market right now, which makes it really attractive. So the upside downside is extremely attractive, right? Because we know that the Department of Energy is chomping on the bit every time oil drops below 70 because they need to replenish the strategic petroleum reserves. We
How
know
much do they
that
have to buy, Rob? How much? Walk us through in simple terms how much they have to buy relative to what they just started buying, right?
they started buying, but it's very small, it's like 3 million barrels a month, which is nothing. And they basically sold 300 million barrels throughout 2022.
So they sold
So
300 million barrels ahead of the midterm elections.
they sold 300 million barrels ahead of the midterms, claiming it was Russia risk was too much. They couldn't afford it, even though the market was really well supplied. They sold nonetheless. So they depleted their inventory of strategic petroleum reserves. They cut it by half, more than half. But what's more important is that most of the oil they sold was heavy sour. And that's the oil that the United States refiners use, not the light sweet. To make a long story short, not going into details, they really don't have much oil anymore in that emergency stockpile to supply the domestic economy if, God forbid, there's a huge shortfall in supplies. And this is where Putin comes in. There's no love lost between Biden and Putin. It's a golden opportunity for Putin to actually try to influence the elections by the most powerful weapon that he has, which is oil. And we know that low information voters in the United States, they care about what they pay at the pump and if they have a job. If oil prices, if gasoline prices at the pump are suddenly going back to $5 a gallon, they will punish the guy who's sitting in the White House. So it's a powerful tool. I don't expect him to use it right now. I'm expecting if this is an option that he's contemplating, he would probably start using it in the spring for a variety of reasons. The winter in Russia makes it hard to reduce supplies. Also, the timing is not there. You want to wait until the spring, summer to drive up oil prices in order to have the maximum amount of leverage and influence in that election. Again, this is a possibility. We're not saying it's a certainty, but it's a great setup because your risk reward is tremendous. Because oil has been, selling off since like early September. The oil majors have been punished, so they're one of the biggest underperforming sectors in the market now. And generally, oil tends to perform better in spring, anyways. And I think
Yeah,
that
the
that's
seasonality, like that's one thing you were talking about in the chat with the institutions on Thursday. The seasonality sets up, like if you're long energy equities or long oil and say oil and gas, well, especially oil between
right.
December and June, that's a better setup, right?
Yeah, oil tends to underperform in the fourth quarter and tends to really outperform towards the end of the first quarter and the second quarter. Uh, People will explain it by, oh, we're going into the driving season peak in the summer. It doesn't really matter. This is generally what the trend is. Year after year, you see that the averages turn out to be that way. So that's one interesting setup. It's
So,
also a way to protect your portfolio because it generally happens to be that when the market goes down, oil goes up, and vice versa. So it's a way to protect your portfolio. Oil is still one of the single most important factors in driving the U.S. economy, and oil prices or oil price disruption of any kind is generally the market doesn't like it. So this is a way to hedge your portfolio as well.
and as so if you look at this chart, so this is the XLE, which is the energy ETF. That's the big oil majors versus the XLK, which is technology. And 2006, 7, 8, that was just a parabolic beating. I mean, the oil stocks every night on Fast Money on CNBC, on all the shows, you had to be long energy stocks. And at one point, I think it was almost 16% of the S&P was energy at one point. And
Right.
now I think you said in the last segment we're down to like 3.6% of the S&P is energy, maybe a little bit less than 4. But I think what's really bullish for me is looking at year end with tax loss selling. You've had a very strong dollar the last couple of years. The global economy's been weak because of 2 wars. And if you get any kind of normalization in the global economy, I mean, there's a billion people in India that don't have air conditioning. We talk about that in the book. There's a billion people in China that don't really own an automobile. But if you look at here, it's the underperformance of that's underperformance as the chart's going down. That's the XLE underperforming the XLK technology. But
Right.
as you can see here, you're breaking out, even though we're in a current downtrend. But overall, we've broken out of a pretty nasty hole. And I just think going into the new year with the SPR refill, as we talked about the situation with Putin and Putin and the Saudis have been holding back production to keep up the oil price. The oil sector is very, very underowned relative to the S&P. There's a ton of money in technology stocks. And what we talk about in the book is kind of that great rotation the next couple of years back into more hard asset companies. When you look at this, Rob, what do you see for an opportunity looking out, say, 24 months?
Well, one thing I want to mention is that, the whole, I should say, concern around Guyana and Venezuela's claim has really impacted three companies, Exxon, Hess, and Chevron. And that happened to be the largest positions in the XLE, which is very top heavy, right? Exxon has about 25%
So
weight in the
Guyana is this
XLE.
incredible world class like reserve, like it's one of the top reserves
Right.
that I think Chevron owns a piece and Hess and Exxon, right? So so so
Yeah, right.
that's controversy because Venezuela is threatening there. Like how big is like the world's, like right now the population of the planet is now going to be close to eight between 8 and 9 billion people, right?
Right.
And so I think we're up near 8 billion people in 2024. But the future reserves, there's a ton of future reserves in Guyana.
Well, this is Exxon's biggest. It's a crown jewel, right? They're expecting to get production up to about more than 1 million barrels a day. This is about a company that had a production of 4.5 million barrels a day back in maybe 10 years ago. And through, basically sitting back, not pursuing any reserve replacement anymore, they've whittled it down to like 3.7, 3.5 million barrels. So they lost about 20% of their daily production through aging reserves and what have you. That. So this is a crown jewel. This is supposed to be the asset that is going to bring that production back to 4.5 million barrels. And that's offshore Guyana. And they have that in collaboration with Hess and in collaboration with Chinese Sinopec. So now, Hess happened to be a target for Chevron. So when the news came out that there were skirmishes around the border between Venezuela and Guyana about 2 weeks ago, both Chevron as well as Exxon as well as Hess all went down because they were terrified that all three, Chevron through the acquisition of Hess, would be impacted by this because if Venezuela does a land grab, they also grab that offshore oil. Of course, they want that. They're poor. The economy is in shambles, so they would not have nothing left. They would rather nothing have than that asset as it's being developed by those three oil majors. So that has also put a big beating into XLE, which is extremely top heavy. It's very heavily weighted towards, I think Chevron and XLE are about 50% of this ETF. And that gives you also a very attractive entry point because in the end of the day, and the referendum came and went. I think it's a storm in a teacup. They're obviously not going to try to grab those assets because if there's one thing that we know is that the U.S. government is going to punish them for it. So there's your opportunity once this thing goes away that people will scale back into these oil majors. So you're right, perhaps right now, maybe not because it's year end. Maybe institutional investors do not want to have these stocks in their portfolio, but that's a very interesting entry point for an individual investor who looks up buy the stocks cheap going into new year with a potential oil disruption coming from Russia going into the elections.
Yeah, that's where you got multipolar world. We still have two wars. You've got all the dynamics around, where is the production relative to the population? So one of the things we talked about in one of the segments last month was if you look at that left-hand side of the screen where the spread between the energy space and technology was $600 billion in 2014. And since then, the global population's gone from what we talked about in our upcoming book, 7.2 billion to 8 billion people. And so we've almost put on an extra 800, 900 million people since 2014. But the capital expenditures of these oil and gas companies, because of ESG, because of regulation, because of companies are more conservative now this cycle versus last, you're in a potential $2 to $3 trillion capex hole, which is the investments you need to find oil and gas to support the global economy. And then you have the whole dynamic with electric vehicles. There's problems with repairs, there's problems with distribution, and it may take a little bit longer, a lot longer to get that whole EV market share gain away. So we could be in a really wacky dynamic where, from 2024 to 2028, we're dramatically undersupplied because we're $2 to $3 trillion of investments in the whole. And at the same time, the global population's up over the last decade, 800 million people. And it just sets up for underinvestment and the whole green meadow thing. That's going to come down the line, but it's a lot slower than people thought. And next thing you know, we're in a 1970s style energy crisis. But Rob, if you want to finish it off, I think that's it for this segment, and Valentina can come in. But if there's any closing comments, Rob?
No, I think we've touched on most of the the important aspects. I think we'll continue to see M&A in the energy space remain very active. As you point out, these companies are cash rich. They rather buy than develop. It's cheaper and it's faster. We also don't know what the policies are going to be 20 years hence. So they rather have the reserves now than developing a greenfield 10 year that will take 10 years. God knows what's going on 10 years from now. So I think that's really a very attractive.
With the regulatory front, it's a lot cheaper to buy a company than to face the regulatory morass and the investment risk.
Right. And so that's something we have to keep in mind.
Really bullish setup, Valentina, for energy 2024, 25, 26. We think energy eventually becomes a much larger component of the S&P 500 than 3.5%. The old high watermark was close to 14. We probably don't get there, but we get a long way back up toward that level. And we're looking at ideas, where's the trade for 2024, 25? Thanks for being with us in this segment. And thank you, Valentina. Thank you, Robert.
Okay. Thank you so much, guys. Again, you always kill it with all of the insightful information and all of the conversation. You guys remember, we have a Bloomberg live chat. You can sit behind Larry. There we have more than 600 institutional investors. But if you're a retail investor, don't worry. We also have products for you. You have to reach me at valentina@thebirdshopsreport.com. That's valentina@thebirdshopsreport.com. And I'm more than happy to give you a 15 to 21 day trial. Also, don't forget to pre-order our upcoming book, How to Listen When Markets Speak. We just got the galleys a few days ago and we're so excited. You can pre-order it in the link down below. Also subscribe and turn on the notifications so you'll be the first to know when we post a new segment. Thank you very much.